As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. We have an extremely popular returning guest tonight. Rob Kirby, founder and host of KirbyAnalytics.com, is here with us again on Reluctant Preppers. He's going to talk to us about the return of volatility to the markets, what it's showing, what it's signifying, and what it means to him, what he thinks we all need to be aware of as far as risk exposure going forward. Rob, thank you so much for joining us again here on Reluctant Preppers.
Pleasure to be with you again, Donegan.
We were just talking briefly about how following quarter after quarter of unnaturally increasing the stock market and bond market and crypto market valuations and continued flatlining of the precious metals, we suddenly have seen in the last quarter or so just a huge change, a sea change in volatility returning of various kinds, and there's been quite a hot debate about whether that indicates the beginning of the end for markets, or if it's just the changing of the guard, people who are at the helm, or what else are the factors that are driving this. Could you guide us through your perspective on what's affecting those various markets and what you think we need to be questioning in the data that we're seeing?
Well, the equity market seems to me that it wants to go down, and it's not being allowed to crash the way it might want to. Dealing with the cryptos seem to me that they're being collared, in that I truly believe that officialdom has taken very large stakes in some of the major cryptos and are using their supply of crypto to prevent them from rising too fast, and they're also have effectively put a floor on the cryptos in terms of they're not going to allow them to decline too much. Basically, they're trying to make the cryptos, I believe, look somewhat stable. The interest rate arena, the Fed is talking a big game about raising rates, but the more the Fed talks about raising rates, the more the long end of the curve seems to be stuck with the 10-year. I'm going to just say between 2.8 and 2.9%, and I haven't even checked it today to see where it is, but I'll bet you it's between 2.8 and 2.9%. And short-term rates, they're signaling that they're going to raise them, but I don't see them raising them much more than they are right now. And I think data will be manufactured going forward to give good reason for them not to raise rates anymore going forward. So that's what I think is in store, and what we've been subject to, in the recent, let's just say 4 to 8 weeks, last couple months. And I misspoke a little bit, because in this rising interest rate environment, I stand corrected. The 10-year is actually at 2.78 today. So it seems that rates are rising everywhere except in the bond market for the time being, because rates don't seem to want to go up. A 10-year bond over 3%, I think, would create some serious havoc in the equity markets and in the economy. And if the Fed continues to raise short-term rates, we could very well be looking at a completely flat yield curve, or even an inverted yield curve. And very flat or inverted yield curves always portend recessions.
Right.
And a recession at a time when next year's budget is projected to be 1.3 trillion in deficit is something that just that's a dog that's going to be very difficult to hunt, because foreigners who America relies on to buy their debt have no appetite for debt when America is exhibiting fiscal insanity.
When you look at one thing we didn't touch on there was precious metals and real estate. Can you give us your view on what's going on in each of those?
Precious metals remain the most suppressed commodities on the planet, and I should hesitate in calling gold and silver commodities, because gold and silver are money, have always been money, and always will be money. And people who like to maintain the fairy tale that gold is not money, I would only remind you to look at the balance sheet of any central bank in the world, and gold is listed there as a tier 1 asset by every central bank in the world. And if you think central banks list things as tier 1 assets that aren't money, think again. And of course, maybe with the exception of the Swiss, because I believe the Swiss National Bank's equity portfolio is up to, I believe, 90 billion in US dollar terms, and that's their equity exposure. Looks like the Swiss are giving maybe the Japanese a good run to see how much of the equity market they can own. So anyway, the central banking concept, this whole central banking concept done again it's so sickening to even contemplate the notion that central banking has anything to do with the capitalist system, which most of the people that would be listening to this broadcast believe they live in probably still capitalist economies. And our capitalist economies really aren't exhibiting much capitalism at all, because central banking is not consistent with capitalist anything. The whole concept of central banking, it's the central plank of the Communist Manifesto. And the degree to which central banks control our world today, instead of showing the failure of capitalism, in my view, they are pointing to and demonstrating the success of the disease of communism, having basically taken over the free world, or what's left of it.
What about real estate? Is that intimately tied to other debt instruments? Because of mortgages are in fact debt based, and so it just goes whichever way the bond market goes.
Well, I look at the real estate market from a U.S. perspective. I would suggest to you, if they allow the 10-year bond or long-term rates to move up much past, using the 10-year as a reference point, if they allow 10-year bond rates to go much further north of 3%, they will bring on a real estate crash and a crisis in real estate like we have never seen before. So, and I think they know it too. And because most people in society have much of their net worth tied up in their homes, this is something that they are not keen to bring on too fast, because this could create social unrest and could create civil unrest, social unrest, and a litany of major bank failures if long end rates are allowed to raise much more than they are. So we ultimately done again. What we have is the Fed basically speaking out of both sides of its mouth. They talk of or threaten higher rates, but they've more or less got themselves in a box where they can't allow long-term rates to increase really much or substantially from where they are. And they've also got themselves, I believe, backed into a corner now with the short-term rates, because if short-term rates do increase, let's just say in a material way from where they currently are, they're going to tip the economy into recession. So, or the threat of the recession might just do the trick as opposed to the real thing. Let's put it this way: if they raise short-term rates much more, instead of foreigners being more wanting to buy U.S. debt, my guess is the prospects and the fear of an oncoming new recession might scare them away. So the Fed is really between a rock and a hard place on the interest rate front, at least so I believe.
What about employment? You mentioned just a little bit ago about manufactured data you foresee going forward to justify the Fed using that to justify not raising rates. And I assume some of that would be manufactured data that says that the economy is not as robust as some people had thought it was going to be. Or can you give us a little bit more understanding of what you meant by that?
I don't believe that the employment data that we've been exposed to is as robust as it's being made out to. We saw a weaker than expected jobs report just reported at the beginning of April, which would have been for March. I believe we saw a stiff revision in the February numbers downward, and there was I believe a very small upward revision to January's numbers. Higher rates will stifle any pickups there have been on the jobs front in construction and home building.
Right.
Manufacturing jobs have been anemic at best, even with call it the Trump bump in employment that we've seen empirically reported by the Bureau of Labor Statistics since he took office.
Yeah.
And I'm much more inclined to concentrate or pay attention to the likes of John Williams of shadowstats.com, who explain to us how completely fictitious government data reporting really is, whether it's on the employment front, whether it's on the inflation front, or the GDP numbers that we're fed. So I'm not John Williams, his shadow stats numbers for unemployment, have the unemployment rate at over 20% in the U.S. I believe that the unemployment rate probably is something of that magnitude if one were to measure it the same way it was measured in 1980.
Right.
Take that and run with it.
What about the impact of Trump's recent moves on both tariffs and repatriation of overseas funds and corporate tax rates? And I guess as long as we're at that, individual tax rates. But can you give us your weigh in on what you think the impact is likely, the real impact on both commerce and the individual Main Street individual is likely to be from all of those factors?
Trump, just to recap what Trump has done, Trump dropped the tax rates for corporations who had huge amounts of retained profits sheltered overseas. To entice them to bring this money home, he lowered corporate tax rates, I believe, from something of around 30% to 15%, And the Chinese basically then responded by saying that they will take corporate tax rates to zero. So, what the upshot of all this, let's say, tax cutting wars between America and China, how this ultimately ends, I think the jury's out on that. My gut tells me that it's going to be tough winning a game of cutting corporate taxes once your major competitor has gone to zero. Whether or not you see, because I don't think Trump is going to cut rates to zero, corporate tax rates to zero. And with China having a 0% tax rate, I mean, we've seen, I believe it was Apple was first out of the blocks, basically becoming very committed to China. And, is Trump's tax cut plan, is it going to mean that dollars get repatriated to America? I don't know. Because, like I say, the Chinese have countered with zero, and while 15% may have looked better than what China formerly had, zero looks better than 15.
Right.
So, I mean, if you're a godless globalist corporation, which the likes of many of these corporations are, zero looks better than 15. So, how this plays out, I don't really know. But what I do see for sure is Trump is spending an awful lot of money, and who's going to pay the bill? I don't know.
Yeah, your point there, with domestic spending for infrastructure and stimulus and so on being proposed at record levels. In the face of that, if you're cutting a significant source of revenue from corporations to the government, what's going to make up for that? And then the answer usually is supposed to be growth, right? But if as you mentioned, if you're in a tax cut war when your opponent's already gone to zero, you can grow as much as you want at zero, and it's not going to necessarily result in revenue.
Well, and you know what, Dunnigan, more so than that, it's not just about the predicament. America's already 21 trillion in debt,
right?
And then and they're projecting to go another 1.3 trillion in debt next year,
right?
Like, and there's really no plans or nothing that anyone can point to show where new revenue is going to come from to fund any of this. And I mean, we've heard anecdotal remarks coming out of Chinese leadership that they're not going to be buying any more U.S. government debt. So my question is, and will be going forward, who's going to buy the debt? Who's going to buy the debt that has to be rolled over, the existing debt, because the existing debt is not something that's been put away forever. The existing debt has maturities of different time periods, and as it comes due, it has to be rolled over, and then add to that another sum of 1.3 trillion to the maturing debt that needs to be rolled, and your biggest traditional financier is making noise that they're not going to buy anymore. And then you have to start asking really hard questions about who. I mean, I have questions about who's buying the debt now. And with the amount of new debt that's coming, and with your traditional biggest financiers not at the table, why is the 10-year rate stuck at 280 or can't get north of 3%? I mean, someone somewhere somehow is buying debt. Whether you see, and you also know from past interviews we've done that I maintain that the Exchange Stabilization Fund, which is a mega $1 trillion slush fund, is buying and memory holding U.S. government debt. And with the Treasury engaged in this kind of activity, the Fed can actually maintain, with a couple of winks thrown in for good measure, that they're not conducting any QE. And from the Fed's balance sheet standpoint, maybe there isn't any Fed QE occurring, but, dollars to donuts, there's QE going on by something or someone or some entity, because foreigners aren't buying the debt and long end rates aren't going up. So somebody's buying the debt. Who's buying the debt? The ESF, I would suggest to you, is buying and memory holding the debt. Now, the problem with this, as I see it, is this opens up a Pandora's box of how much money is there really in existence. Because the Fed gives us monetary aggregate data telling us about the supply of money as it's defined by M1, M2. They don't report M3 anymore. And they tell us that the money supply is X size and their balance sheet is X size. But and then you have to start considering the work of people, the likes of Dr. Mark Skidmore from Michigan State University and the work he's done with Catherine Fitz, where they've identified $21 trillion in missing money stemming from two government agencies, namely the Department of Defense and HUD, Housing and Urban Development. And you quickly come to the realization that there's much more money in existence than anyone admits. And much of this money, refer to it as dark money, much of this dark money is housed in entities like the Exchange Stabilization Fund. And it's these resources that get marshaled up when they need interventions. When they need interventions to goose the stock market or prevent a collapse, when they need resources to suppress metals prices, because metals are the arch rivals of the fiat dollar, and when they need money or participation in U.S. government debt auctions, because God knows we certainly have never had a failed U.S. government bond auction. And remarkably, every other sovereign entity on the planet that issues debt has at one time or another had a failed bond auction.
Right.
But never in America, because America is special. Well, the real reason is America has an ESF with tens of trillions of dollars of slush fund, and they can marshal that up anytime they want to basically accomplish any criminal, insidious, hideous program they wish to engage in. And that's exactly what's going on. So the bond market, as we accept it, or as the mainstream accepts it, is smoke and mirrors. A big smoke and mirrors. Just like the American media is smoke and mirrors. It's all a lie. It's all propaganda. And so is the bond market. It's the biggest Ponzi scheme ever created. That's my story, and I'm sticking to it.
Well, at this point, a lot of what you've said can be backed up by both the hard research and the numbers that are out there, and it's just surreal that most of the talking heads aren't pointing out these glaring discrepancies that are present in these incredibly important ways. So that leaves the average person, and we've only got a couple minutes left. If you could just tie it up for us as far as what steps an average person can do to reduce their risk exposure to this world gone mad of unreal management at the highest levels.
Yeah. Well, you know what, Dunnigan? Staying true to the namesake of your website, Reluctant Preppers, I recommend that everyone reluctantly get prepared, and everyone should reluctantly, even if it is reluctantly, and soon it probably won't be reluctantly. Soon it might be a mad dash or a mad rush to get prepared. But having some storable food on hand, and having some tangible financial wealth on hand. And when I speak of tangible financial wealth, I'm speaking about gold and silver, and I'm talking about physical, not in the paper form, like not mining shares. I'm not talking about owning shares of GLD or SLV that claim to be physical or represent physical metal. I'm talking about going to a coin store, buying coins or bars, likely in smaller denominations, and hiding them and having them within your control. And hopefully it doesn't come to that. But you know what? It sure looks like precious metals, which haven't been looking especially precious for the past 7 years since their big takedown in 2011. I'll give anyone who says that, I'll give them credit, because there's been an unbelievable suppressive attack mounted on the metals. But the physical precious metals at some point in time in the near future, I believe, are going to make what's occurred in cryptocurrencies or Bitcoin look like small potatoes.
A lot of our viewers have been anticipating that and wondering how many years they need to be basically on. That's that old saying, I'd rather be 7 years early than 1 day late. And many of our guests have reminded us that by the time it becomes obvious to the masses that that's the right side to be on, it'll be too late to get on that side. So that's, I guess, the essence of contrarian positioning to reduce risk. We've been talking with Rob Kirby, founder of KirbyAnalytics.com. Rob, is there any parting thought you want to leave with our viewers and where they can find your work?
You can catch me on the web at KirbyAnalytics.com. And I guess as a parting word, stay long and strong physical precious metal.
Thank you, Rob, as always, for joining us here on Reluctant Preppers.
It's been my pleasure, Dunnigan.